of these problems are these spike hikes going to be, these price spikes going to be? I want to bring in market watcher Adam Lashinsky. He says it's no big deal, but Kathryn Rooney Vera, she disagrees. I'll start with you, Kathryn.
Inflation is a very pernicious force, especially when it's fomented not just by transitory factors, Charles, such as the chip shortage, raw material shortage, and base effects, but because of inordinate, profligate government spending, which is the situation under which we're living in right now, as well exacerbated by Federal Reserve policy, which is we're out of the emergency, Charles, but we're still in emergency measures. The Fed is still buying $120 billion of assets every single month. And the Biden administration is acting like we're in the middle of a pandemic with these inordinate multi-trillion-dollar packages. What happens here? And the CBO, the Congressional Budget Office, says it very clearly. Over the course of the next couple of decades, at current trends, interest payments on our debt are going to be more than Social Security. And we know what a disaster of an unfunded, mass Social Security is. But inevitably, once interest rates go higher, Charles, we're going to have to be financing a very big part of that debt, which is already at $25 trillion.
Yeah, maybe $1 trillion a year. Adam, you're one of the smartest market people I know. Certainly the stock market is screaming that inflation could be a serious problem. Shouldn't we take that message seriously? Kathryn, on Friday last week, consumer sentiment, probably the big news of the week. Consumers see one-year inflation that Adam's talking about going to 4.6% from 3.4% in April. That is devastating. To your point, the Fed couldn't do nothing if that's the case. They would be at the will of the market, and we'd all really feel the pinch, wouldn't we?
Well, yes, and Adam's right. Right now and through July of this year, all of the inflation that we're seeing right now is simply because of base effects. In this month of last year, inflation was growing at 0%. So when you have such a low base, of course those numbers are going to look astronomical. That's going to phase out by July of this year. We're going to see inflation decelerate. But Charles, by the end of this year, we are going to completely close the output gap in the United States. It's a definitive V-shaped recovery. Demand is roaring back. So you have the combination of demand, pull inflation, plus fiscal stimuli, plus monetary stimuli, so that I do think that even though these inflationary factors are transitory for now, for the next 3 months, in 12 months, 18 months, we're going to see the real deal. And that's structural inflation. And that comes from a robust economy and a government spending.
You know, Kathryn, we are seeing a lot of businesses saying, listen, we're going to pay workers more. Amazon's going to pay 75,000 warehouse workers $17 an hour. Bank of America is going to $25 minimum wage. Again, these are large, well-heeled companies. Should we just let the free markets do this? I mean, it feels like they're moving in the right direction.
We're in corporate welfare right now. Ever since the crisis began, that has been the case. The rich get richer, the corporations are making mega bucks, and the people that don't have access to that financing, then subsidized loans by the federal government, doesn't even have the money, Charles, to be subsidizing loans to the big corporations, are losing out. So you have this massive inequality and wealth gap that's huge now and only expanding.
Yeah. You know, Adam, I think I found someone finally smarter than you on one of these segments. I want to say thank you to both of you. Appreciate it.